Thank you so much for joining us on the Dwelling Show. I'm your host, Ola Dantes. I've got Eric Tait with us today. Hey, Eric, how are you doing today?
I'm good. How are you?
Doing fantastic. So, first and foremost, you're MD, you're a doctor, and you're obviously now into real estate. So, I'm sure you could do a way better job kind of telling our door listeners a little bit more about, who you are and kind of your journey up until now.
Yeah, no problem. So yes, as you talked about it, I am a physician, so I'm Dr. Eric Tait. Originally from Mount Vernon, New York. Went to Morehouse College in the mid '90s. Went to Baylor College of Medicine for medical school and Rice University for business school. So I did a dual degree, MD, MBA. In business school, once I figured out kind of how the stock market worked, I just didn't want to have my and went out and looked for ways to try to figure out how I could invest. Looked at franchising and operating businesses and all of those type of things, but realized that the highest and best use of my time initially was to practice medicine and then look for ways in kind of the real estate to try to create at least semi-passive income through that process. And so started with single family homes, moved on to small multifamily, had some physician colleagues who wanted to invest with us. And so then we started doing larger projects like larger multifamily, hotels, commercial investments, things of that nature.
Awesome. So you guys started from, small, single family and then kind of moved into multifamily. Why did you guys make that shift?
Well, we didn't know any better. That's the usual progression that people understand. If I had to do it over again, I would have gone straight to kind of larger multifamily, larger projects at the outset. But, fear gets in the way. Lack of knowledge and understanding gets in the way. So you think you have to start small because you think you have to start with what you immediately know and have a frame of reference to, not understanding that you can get training or participate with people who know what it is that they're doing immediately. And so, as I like to say, all money's green. It's just a matter of where you're going to allocate it to.
So there might be a lot of listeners thinking, wow, this guy's a doctor. And doctors like getting paid? Like, don't they make like tons and tons of money? Why would a doctor want to invest in real estate? What do you say to that?
So the money isn't really as important as for me was the time, right? I wanted time freedom. And so in a service-based business, you're trading time for dollars. And so if you're not able to scale into something that does not require your labor for you to get paid, you can make $1 million a year, but you still have to get up and go to work every day if you're making that $1 million a year off of your labor. And so my guiding star initially was just to get financially free so that I could control my time and do what it is that I wanted to do with my time. And that to me was the guiding star. So it wasn't about making a ton of money. Money's just a tool to create the life that you want to create.
Awesome. So let's kind of rewind back a little bit. So you went to medical school, you came out, you have your MBA, you were doing some kind of research on whether to invest in real estate, or you said the stock market and franchising and different kind of vehicles, right? Why did you land on real estate? I'm kind of curious, actually.
There are really only two ways that people become financially independent at a relatively young age. That's owning a non-service-based business and investing in real estate. So, I'm not the smartest, knife in the drawer or sharpest knife in the drawer necessarily. So it's one of the two things. I wasn't going to have the time to run a non-service-based business being a physician. So I was like, well, let's just do real estate. So I don't need to reinvent the wheel. There's a well-worn pathway to wealth. You don't have to be super kind of creative, just learn a few principles and then go forward around those principles. And, real estate's been around since time immemorial.
Mm-hmm. Okay. So you did do that, invest in real estate. So can you tell us about your first deal? How did that deal go? How did you find it and how did you fund it?
The first deal was I just bought my condo when I was in medical school. It was just putting the money down. So I just did a partnership with my mom. She would get initially she would get the tax, she would put the down payment, and I would give her the tax breaks from the write-offs. Then I rented it out when I went to residency.
Why don't we do the actual first investment deal? Sorry.
Well, I knew I was going to end up renting that out because I was staying in Houston. So that was really technically the first investment deal. That was probably 23 at the time. Then when I got out of residency, I bought a closed property, which we still have to this day. We've only had probably 2 tenants in there. This was in 2007. It was just a 3-bedroom, 2-bath foreclosure on the north side of Houston, Spring, Texas. It's $44,000. It's probably worth about 135 right now. We did what's called a 2-step close, so we didn't have to put any money out of pocket. And I know you don't want to get super technical, so I won't go into that, but that was actually a no money down deal because we were starting to go into the economic downturn at that time. And so property prices were falling, even though rents were rising. And a good lender understood that and was like, well, we know the value of this property is this, so we're going to lend you 70% of what that value was, which was probably around $70,000, even though we only needed $40,000 to buy it. So once you understand certain principles, there are ways that you can get into projects and get into assets, not necessarily in a conventional way. And then in 2008, we bought our first small multifamily conventionally, because a bank's not going to let you kind of do a no money down kind of deal in that way. And I would argue we weren't experienced enough to do that with that size of asset anyway. And that was just a traditional 35% down, small 10-unit complex, just so I could cut my teeth and learn kind of what that looked like.
So you cut your teeth into the multifamily space. How did that go for you in terms of that managing that 10 unit asset compared to kind of owning some properties, some single family? What was that stark difference like?
They're really not at all similar. So this was a C-class apartment. It's D that we were taking to C-class apartment. The single family home was just a beat up suburban home. They have different tenant profiles, different kind of maintenance profiles. They're just very different animals. And the interesting thing is, even a small multifamily is not really super akin to a large multifamily. They're really different skill sets with some slight overlap similarities, but in all honesty, there were not necessarily translatable skills from having the experience of doing one to going to the other. I had to learn a whole new skill set going from each of these different kinds of asset classes. And so from a hassle standpoint, the single family homes, we still got dozens of those. We're actually less hassle than the multifamily on a day-to-day management basis, because a small multifamily can't really, from an economies of scale standpoint, support full-time professional property management. Whereas you can offload a ton of maintenance onto single-family tenants, at least in the state of Texas, that you're not going to get called for. It's their responsibility. Whereas you really can't do that in apartments because it's a different type of tenant with different types of expectations.
Okay, so what did you do after this 10 units? So you cut your teeth into it, you kind of got a good hands-on grasp of how to, run this kind of asset. What did you do after that?
Mm-hmm. So after that, we had some of our physician colleagues who kind of looked at what we were doing and said, hey, can we join you? What is that? What would that look like? So I went to a securities attorney and asked them kind of, hey, how do we allow people to do this? And they're like, oh, here's your paperwork. This is what you can do. You can raise all the money you want in the world. Just make sure you give them this paperwork and tell them you're going to lose all their money. And if they still sign up with you, you're good to go. Send this document to the SEC every time you raise some capital. So at that point, we said, okay, let's look at figuring out what was in the marketplace. So we put together a debt fund to lend against a lot of these single family homes, because at this point we were in 2011, 12. Banks really weren't lending again. And to be able to come in and buy some of these properties, it was just easier to try to bring in your own debt. Did a small round doing that. Then I realized very quickly I didn't have the skill sets to really raise capital outside of people that I didn't know. And so then I went on a journey to figure out to learn how to do that. In the meantime, with friends and family, we got into a hotel project in the Caribbean, put some money together for that. That's just starting to kind of come to fruition now. It was 2014 at that point in time. Then we bought a large multifamily property not far from the other one we had. It's about 100 units. Started that process around this time as well. And then started looking at other kind of larger projects to focus on.
So you guys went from the hotel to apartments as well. So you kind of went from apartments to hotel, and when you're making kind of this transition, are you kind of getting a mentor or some kind of like education, or are you making these jumps from the different asset classes?
Yeah, so I don't do anything without a mentor. I spend probably 10% of my income a year on personal development and education. Literally, I was just speaking at a conference this weekend. So again, like I say, I don't need to come up with things myself. There are experts in each one of these places that I just plug into. What I have the benefit of doing is I have a group of investors who want hard assets that generate cash flow or hard assets that generate a capital gain. So I can add value to people by saying, hey, if this makes sense, you know, from my standpoint, like our investment firm is how I invest my own money. So it's literally how I want to invest. So my big thing is I pay attention to macroeconomic trends and I know kind of where I want to position our company to take advantage of those long-term kind of trends. Kind of the rich are getting richer, the poor are getting poorer, the middle class is wiping away. So we're either going to cater to the high end or we're going to cater to workforce. In the end, ultimately, the asset doesn't really matter because the asset is just there to solve a particular problem that a market has. So I'm looking for a great market that has a problem. And then I'm going to put together a team that knows how to solve that problem. And then we'll bring our investment dollars into that. And so, yes, absolutely. I find mentors, I find experts, and I just partner with experts in those particular areas. Now, the good thing is I know how to operate. I can operate multifamily properties. I can operate single family homes. I can operate small commercial projects. I know how to do that. I know how to hire contractors. I know how to do due diligence. I know how to personally do those things. I just choose not to anymore because it's not fun for me. It's not what I like doing. I like talking to investors. I like going out and finding the next market we want to be in. And so having the knowledge base of understanding how someone who's going to be operating a project you may be a part of, I think is invaluable for me and invaluable for our investors.
Yeah, no, I think that's a really, really great point you made. You shouldn't really try to reinvent the wheel. Why put all that effort when there's somebody that actually has a quasi or proven process that works? So the other thing you mentioned, where kind of microeconomic, elements that you look at in terms of choosing a market. So can you kind of touch on those? How do you actually find out, a market, that you want to go into? What does that process look like?
So let's just keep it because I could go across we own farmland. I could go across all of those, but let's just keep it for multifamily. Okay. If we take the supposition that the wealthy are getting wealthier and the poor, the working poor are staying where they are and growing in number. And we can pull that from headlines, right? We can just pull that from Google, what have you, right? So that's the top macroeconomic trend. We also know that we are down millions of workforce housing units, whether that's single family homes or apartments. So in many markets, you will see people building A-class apartments, the really expensive stuff that people can't afford. But when it comes to more affordable apartments and housing, less and less of that. And so what I just look at is kind of population trends. Where are people moving? Where are jobs moving to? What does that look like? Ideally, you're looking at if there are places that have geographic restrictions, meaning they potentially have land use restrictions, that can potentially be helpful. You just have to be careful because in many places that have land use restrictions, they're also very quote unquote progressive or liberal, which means that they're going to have favorable tenant laws against landlords. And I don't really believe in that. So, you're not going to really see us in New York and California and the Pacific Northwest looking at residential properties because they don't respect property rights. And so from that standpoint, you can't really have capitalism if the capital isn't respected. So we'll take all of those kinds of things. So really the big thing is population growth, job growth, are the two big main drivers. And then the question you have to ask yourself is with the job growth, are the jobs concentrated in a specific industry or are they widespread and relatively broad based? You want to be careful of what do we call company towns where there's only one major employer in the area where you are. So if something happens in that particular industry, your tenant base is essentially going to have a problem. And so those are just kind of high level things we look at from a due diligence standpoint. And from a rough geographic standpoint, we're going to look kind of from Southern Virginia all the way through kind of Arizona, kind of what we call kind of the Sun Belt in the United States, and primary, secondary, and even tertiary markets in those areas. Because if you look at the population and demographic trends, those cities, those major cities, and even those tertiary cities are experiencing population and job growth because many of the millennials and the Z generation are moving to those cities.
So it's really interesting, right? Because as you talk, I just kind of something just came to my mind. So you're pretty invested in real estate investing in kind of across all these different asset classes, across geographical markets. What some dualists might be thinking, well, do you still practice medicine? And which is kind of my, my segue to my next question. So do you still practice medicine, and what does the future look like, for you and for your company?
So I do still practice medicine. I see patients usually one day a week, usually on Wednesday. So I have a schedule tomorrow. I'll check with my assistant today to see how many people we have on the schedule. And then I'll go in other days as long as I'm in town. If a patient can't make it that day, I'll go in. So yes, I still do practice medicine because I am a physician and I like to practice medicine. From a filter standpoint, like everything in business, it's a relationship. So ultimately, I tend to work with people that I have a direct relationship, or someone I know has said, "Hey, you got to kind of talk to these guys. You got to go see these guys." And then at that point, it's just a diligence process, right? That we will go through, because I can do the market analysis easily myself, right? That's not an issue. But then it's really the people analysis that's next, right? I've been in enough deals with people that you can't do great business with a bad partner. So kicking the hood of the people that you're going to be working with is a big deal, right? Track record is great. But you also want to see how they treat other people, kind of what their vendors say about them, what you may or may not be able to talk to their investors because, many people sign NDAs. They won't release kind of who their investors are because their investors don't want to necessarily be known. But there's still ways that you can get a good function in the marketplace of where they are. Google is really your friend. See how they Google, do they Google well? From that standpoint. So for me, it's relational because again, the asset is the least important process behind all of this. The people, and have they gone through a downturn somewhere in their life? Have they had a bankruptcy? Have they had some horrible issue happen that they had to figure out a way to dig themselves out? That's really important to me.
Yeah, that's really interesting. You put all that together. So I mean, I can talk to you all day, but we don't have all day. So we're definitely dwelling into the quick rounds. These are going to be quick questions, quick answers. You ready, sir?
Okay.
All right. First question: what makes you, Eric, unique? What is that differentiating factor that separates you from the next guy or from the next girl?
So I've come to realize that my superpower is synthesis. So I'm not great taking things from nothing and building something. All I need is a little piece of clay or building block, and I can make connections across industries. I can make connections across asset classes. I can make connections across industry silos very, very quickly. And so that's really that ability to synthesize information from disparate parts. I can do very, very quickly.
Awesome. What was the last book that you read? What was the one thing you picked up from that book?
Actually, I just was reading Fake by Robert Kiyosaki. It just talked about kind of fake teachers, fake assets. I mean, we live in a world of ephemera, where people say things are worth something, and they worth something because they say it's worth something, even if it doesn't produce anything. And we have learned to trust things that don't exist because people say that they're worth something, as opposed to focusing on primary wealth. And don't get me wrong, I'm not a Luddite. We have technology investments, blockchain investments, things that I'm a Luddite. But we let people who are essentially salespeople educate us and don't realize it. And so that helped me to crystallize how many fake people are out there just trying to be in your pockets, but aren't adding value and don't know what a real downturn or a real depression would actually look like with all of the fake assets that we have, mainly derivatives, in the marketplace.
Oh, fascinating. So you're practicing, MD, you're speaking at conferences, you've got all this, you're managing all these assets, all these investors. What do you do for fun?
So, I believe so a mentor of mine said it, and it's correct. Build a life that you get paid to live. We own assets in the Caribbean. We own assets in Central America. Our investors can go down there and enjoy those assets. I mean, I like to integrate in some ways our investing with our personal life, right? I like to travel, so we have assets in multiple places. Allows us to write off our travel, right? I'm a cigar guy, so at least 2 or 3 times a week, I'm somewhere. Even if I'm not smoking, I'm going to be in a cigar place, just with an hour to myself, just to think. I'm a water guy, so we've got a place by the water that I can just go and relax. And because I'm low maintenance, right? I don't have to be doing a lot of stuff. As long as I can shut my mind off and have to worry about doing a lot of minutia, that is enjoyable to me. Time with my family is enjoyable to me. We were all together this weekend down at my college homecoming, right? Even though I had to fly out to do something, but usually every year we're doing that. I was down there seeing my friends from college that I've been with for 25 years, right? So for me, I'm just low maintenance. Connections and time to think are the big things for me.
Awesome. Eric, that's been great. I mean, if there's somebody listening and thinking, wow, maybe they're in the Texas market or anywhere in the country, or maybe they're, MDs just like you, and they're like, wow, I like this guy, I want to connect with this guy. What is the best place folks can reach out, connect with you?
You can always email me, and I'm going to spell it out because our company name is a little bit interesting. So it's just Eric, ERIC, at Vernonville, VERNONVILLE.com. So it's just Eric at Vernonville.com. Or you can just go to Vernonville.com, VERNONVILLE.com, and just email us through there. And I'm around. And you can just Google my name, Eric, ERIC, Tait, Tait. I kind of come up a lot. So it's fairly easy to find me. I'm pretty easy to find.
Awesome. And we're going to put it on the show notes as well for our dual listeners, so it'll be easy for them to grab that there. Eric, thank you so much. It's been an absolute pleasure. I really appreciate our time today.
Thanks, Ola. I appreciate time as well.